Hi, everyone, and welcome to the final installment of the IRA Cafe for 2023. As we are all finishing up this year, we'd like to wish you all happy holidays and happy new year, and we're looking forward to an exciting year ahead in 2024. My name is Kyle Moody, and I'm with the sales team here. If this is your first time joining us, we welcome you. We hope that you come back for some other informative sessions and see how your retirement account can really be boosted by diversifying your portfolio and investing with a self-directed account with American IRA. Normally, we'll have a lot of background on the company here. We've got a lot to cover today, so we're going to jump right in to everything. But before we do, the most important thing that I'd like to tell everyone is, again, and now whether you've been on a phone call with me before, some of the things that you will hear us say is that we are not a fiduciary. Therefore, I cannot render any tax, legal, or financial advice, suggestions, or opinions. And that's actually going to be the mantra of today. I'm not going to be doing that. I'm basically going to be delivering some information for you to be able to absorb, think about with your own retirement accounts. Some of these things may be a first for you to hear. Other folks may be sharpening the saw with some of this information. Either way, it's good if you need to get more information for you to reach out to your CPA or your attorney or anyone in those professional fields. There are a couple of things where you think you might want to call into our offices to drill down more, and I will tell you that we will be encouraging you to speak with the professionals that I just named. But again, it's some good information. Just as we've seen over the years, and as we get near the end of the year here ourselves, just hearing from clients over the years themselves, what they have done. We've been able to compile this and put it into this presentation for you today. And as we all know, the end and beginning of a year are chaotic times. Between the holidays, visiting friends and family, and buying gifts, we're all bombarded with information, deadlines, and requirements. And hey, I'm no different. Some of it I respond to or jump on immediately. And other times I am guilty, I'm sure like a lot of others, of pushing things on the back burner. Unfortunately, tax season also rears its head around this time, and it's not a back burner item. So we want to ensure everyone has their retirement ducks in a row before more chaos ensues. Before the year ends, investors should take a look at their 401k or Roth and traditional IRAs and see if there's anything that needs adjusting, and that includes your contribution amount. Just like you should give your retirement portfolio a once-over, do the same with any taxable accounts so that your investment portfolio stays aligned with your goals and your desired asset allocation. So in today's installment of IRA Cafe, we will be discussing some year-end hot topics like qualified charitable distributions, also known as QCDs, required minimum distributions, you'll hear us call those RMDs, and a fair market valuation, an FMV, and other acronyms from A to Z to prepare you for the end of 2023 and get you all set heading out into 2024. Well, if you're like me, and if you're like Santa, you're making a list and you're checking it twice. Here's some common tasks that should be on your radar before December the 31st. Number one is maxing out your 401k. Do you already have one? Great. Try to stuff as much as you can into it. This may reduce your income tax bill. If you don't have a 401k, that's okay. In fact, give us a call and let's see if you qualify for a solo 401k. Number two, take your RMDs. We will talk more about RMDs later. If you're over the age of 73, you must take them prior to the end of the year or you may face a penalty. Adjust your planned contribution levels for 2024. This can reflect increases in allowable contributions or income limits. You may also be able to contribute more to retirement plans than you could this past year. Talk to your CPA. There may be some things you can do to mitigate any possible exposure to the alternative minimum tax. Top off your IRAs. Can you make more contributions? Go ahead and put them in. You still have until April 15th, however, to make an IRA contribution for this year. And listen, if you have to choose, contribute to your 401k plan and then take advantage of the longer IRA deadline to catch up. You still have until April 15th, however, to make IRA contributions for this year. So if you have to choose, go ahead and contribute to your 401k and then take advantage of the longer IRA deadline to catch up. Do an age check. Did you turn 50 or older this year? You may be able to make additional catch-up contributions to retirement plans. Check your total contributions. Did you over-contribute? Make the withdrawals while you still can to avoid over-contribution taxes. Can you make business purchases? Committing funds to business expenses may create a tax-deductible expense this year. Commit those last few dollars in flexible spending arrangements. And take a look at Roth IRA conversion strategies. Was your income unusually low this year? It may make sense to pay the income taxes on your IRA growth now rather than wait until you make distributions and pay full boat income tax at a possibly higher rate in retirement. Contribute to a covered L ESA for a loved one. You can self-direct with a covered L too. Review your estate plan. Although your estate plan isn't an investment, it determines what happens to your investments once you die. So here are a few questions you might want to ask yourself. Have you included all of your assets in your estate plan, especially ones you recently acquired? Do you have the most recent appraisals of any properties you own? Do your will and beneficiaries still align with your wishes? Are you setting up your estate in the most tax-efficient way? And now on to a QCD, and let's start with what that QCD is. Qualified Charitable Distribution, or QCD, is a way IRA owners, and yes, including self-directed IRA owners, can donate money to charities while also reducing your required minimum distribution at the same time. You do not get the deduction for charitable giving. After all, if the money is in a traditional IRA, you have already taken the deduction, discounting non-deductible contributions. So there is nothing to deduct against. Like most things with the IRS, there happens to be a few rules regarding this type of distribution. First, you may only donate up to $100,000 per calendar year from an IRA to an eligible charity tax-free if you meet specified requirements. If those requirements are met, a QCD of an aggregate of $50,000 may be also made to split interest entities. Let's look at a few more rules. If you wish to make a QCD, keep in mind that you must be at least 70 and a half on the date the QCD is made from your IRA. You also may not make a QCD from any ongoing SEP or simple IRA account. Ongoing refers to an account that an employer is still making contributions to within a taxable year. However, what if your accounts are held by an employer plan like a pension, a defined contribution, a 403B plan, or a government-held 457B plan? In short, these accounts would need to be rolled over to an IRA to be considered eligible for this type of distribution. By the way, I'm not going into the specifics here, but if you're in question on whether any or all of these funds are able to be moved, you'll want to check with your custodian or HR and ask if you're eligible for an in-service rollover. And again, that's if you are still employed in any of these where these plans are in play. Once you have the basics of what it takes to make an eligible QCD, it's important to understand some of the requirements around distributing this money from your IRA, as well as some timing requirements. As it stands, you can still take money out of IRAs to donate to charities. You just can't reduce your RMD by doing so. Let's look at a few more rules. If you wish to make a QCD, keep in mind that you must be at least 70 and a half on the date that the QCD is made from your IRA. You also may not make a QCD from any ongoing SEP or simple IRA account. Ongoing refers to an account that an employer is still making contributions to within that taxable year. However, what if your accounts are held by an employer like a pension, a defined contribution, a 403B, or a government-held 457 plan? In short, these accounts would need to be rolled over into an IRA to be considered eligible for this type of distribution. By the way, and I'm not going to go into the specifics here, but if you're in question on whether or not any of these funds are able to be moved, you'll want to check in with your custodian or HR and ask if you're eligible for an in-service rollover. Once you have the basics of what it takes to make an eligible QCD, it's important to understand some of the requirements around distributing this money from your IRA, as well as some timing requirements. As it stands, you can still take money out of an IRA to donate to charities. You just can't reduce your RMD by doing so. Instead, you can take a distribution directly and then forward the distribution to a charity, taking the tax deduction on your own personal income tax return. Now, the catch is you can only deduct charitable gifts as miscellaneous itemized deductions, which means A, you must itemize your deductions to get any benefit, and B, those combined miscellaneous itemized deductions must exceed 2% of your adjusted gross income threshold for them to reduce your tax bill. There is some language that you might find in the IRS code about charitable organizations and how it might be described, and it does not include an organization described in another IRS code. Just know that your aggregate amount cannot exceed $50,000. If you have a Roth IRA, then your distribution is tax-free, assuming the money has been in for over 5 years and you're over 59 and a half, or taking Section 72T in distributions. And there are no RMDs to worry about anyway. In this case, you may still be able to take the tax deduction if you have other income to deduct against. You can't deduct against the income you receive from the Roth IRA, though, because it's considered non-taxable income. A QCD must be coordinated with deductible traditional IRA contributions so that the excludable portion of a QCD for a taxable year is reduced, not below zero, by the aggregate deductions of traditional IRA contributions for the year of the QCD and all taxable years ending on or after the date the IRA owner attained age 70 and a half. So let's break that down. When you make a qualified charitable distribution, or your QCD, you need to pair it up with deductible traditional IRA contributions. This way, the portion of your QCD that doesn't count towards your taxable income for the year is lowered, but not below zero, by all your traditional IRA contributions for that year and all the years after you turn 70 and a half. Here's the kicker, though. Once your QCD excludable amount is reduced by deductible IRA contribution, that deductible contribution can't slash the excludable amount of another QCD. QCDs are not subject to tax withholdings. Now, that right there is one of the examples of good information. Everything has been put together. We've heard that from clientele and how we've been able to piece this together. A solid example, though, that if you have questions about this, if it does pertain to you, you're going to want to get in touch with your tax professional to go over that. We've discussed a lot of different qualifications and requirements needed for the QCD, so let's chat about that tax report. QCDs do not require any special reporting on Form 1099-R in the year that the QCD is made. They only require the custodian to report the amount as a regular distribution. The tax preparer or your CPA is required to report the amount as a non-taxable QCD on the IRA owner's tax return, according to instructions for IRS Form 1040. If the IRA owner had his or her traditional IRA, the tax preparer might be required to file IRS Form 8606 with the tax return if the IRA owner received a distribution from the IRA during the same year, other than the QCD, or the QCD was made from a Roth IRA. Switching gears a little bit, we're going to talk about the required minimum distributions, or the RMDs. When you hold a certain type of self-directed IRA, the government may require you to take out RMDs at a certain point. Why is that? Because when you use pre-tax money on these self-directed IRAs, you legally avoid paying the taxes on a portion of your income. That's because the retirement account then holds that money, and you can then pay taxes on that income when you take it in retirement. However, the government does want to make sure it eventually gets these taxes, which means that when the RMDs kick in at a certain age, you'll have to take the money out. Failure to take your required minimum distribution can have serious tax consequences. I'm actually going to touch on that a couple slides down, but we wanted to go ahead and tee that up. Other than the charitable giving, there's some other tips that we wanted to cover with you on how you can better service your IRA at the end of the year. One of the most powerful ways to avoid paying the RMDs, switch to an account that doesn't have RMDs. With a traditional IRA, you can usually deduct contributions from your income taxes, but with Roth IRAs, you're then using after-tax money to fund the account. In other words, you can use a self-directed Roth to avoid any RMDs the right way. Rolling or converting the money over into a Roth can be a taxable event. That means that you will owe taxes on the pre-tax money that you're trying to convert into a Roth. This is a one-time event, and after that, you'll have money within the self-directed Roth IRA that doesn't have RMDs. You can then continue to contribute to this Roth IRA indefinitely. After all, there are no RMDs with a Roth IRA when you have a Roth IRA ready to go. For future contributions, just make sure you do not exceed the income threshold. Consult the Joint Life and Last Survivor Expectancy Table. The Uniform Lifetime Table is something that not many people know about, but can have powerful impact on the way you invest and plan for retirement. It's what most people are used to. However, the Joint Life and Last Survivor Expectancy Table requires a different life situation. The key here is obviously to have a different style of life from people on the Uniform Lifetime Table. So make sure that you consult with a tax professional to make sure you're in a situation where these different tables will have an impact on the way you plan for retirement. Of course, whether you take distributions in one year or the next might not matter to many, but they might matter to you. Make sure you consult with a tax professional to make sure you are using everything you need to optimize when you take your distributions in terms of how it impacts your taxes. While we're here, let's go ahead and discuss some other tips to keep in mind when preparing your retirement accounts for RMDs. You might believe that finding the best way to accumulate funds for retirement is difficult. Well, guess what? Withdrawing those funds is just as hard, if not harder, if you want to do it in a tax-savvy way. Failure to meet this challenge could result in you losing over half of your retirement money to income, state, and estate taxes. Taking your distributions too early or failing to take the required distributions from your traditional self-directed IRA are the two most common and costly mistakes that retirement savers make. Even though you're allowed to take distributions from your traditional self-directed IRA at any time, you almost always need to be 59 and a half years old to avoid a 10% early withdrawal penalty. And that penalty is in addition to the income taxes you will owe. There are, however, some exceptions that will waive the penalty, like you become disabled, you have medical expenses that are greater than 10% of your adjusted gross income, you use the money for qualified education expenses, you convert your traditional IRA to a Roth IRA, you purchase your first house with the funds. If you die, the balance of your self-directed IRA account is paid to your beneficiary without penalty. There are other exceptions, so talk to your accountant to make sure that you qualify. You must take your first RMD by April 1st of the year after you turn 70 and a half. So if you turn 70 and a half in 2023, you have until April 1st of 2024 to make your initial withdrawal. From then on, you have until December 31st. Do not take this rule lightly. The penalty for missing the deadline or taking out less than the required amount is a heart-stopping 50% excise tax. If you have IRAs at several institutions, it doesn't matter from which of these you take the distributions. All of them add up to the required amount. That's why it's essential that you know your RMD numbers, so there's no confusion when multiple institutions hold your accounts. There are some loopholes to these rules. If your spouse is more than 10 years younger than you, the Joint Life and Last Survivor Table will allow you to make smaller RMD withdrawals. For example, a retiree turning 70 and a half this year and makes his first withdrawal next April will have a life expectancy of 26 and a half years. If, however, he had a 56-year-old wife, their joint life expectancy would jump to over 30 years, and their annual RMD would fall from about $7,550 to $6,650 on a $200,000 account. Lastly, you're able to make in-kind withdrawals from your self-directed IRA. Let's say you have some assets in your self-directed IRA that you prefer to keep. In-kind distributions make it possible for you to move these assets into a taxable account without first turning them into cash. The assets are assigned a fair market value when they are moved and will count towards your RMD. Now that we've covered the RMDs, let's get into fair market valuations. As we approach the end of the year, it's important to start thinking about your financial reporting of your self-directed retirement account. One crucial step that often gets overlooked is submitting your FMV by January the 31st of 2024 in this next case. This annual requirement from the IRS is essential in accurately assessing your assets and investments and ultimately your overall financial health. As you navigate the world of self-directed retirement accounts and financial planning, one term you may come across are the FMVs. But what exactly is the FMV and why is it so important? At its core, the FMV refers to the estimated value of an asset or investment that would be agreed upon by a willing buyer and a willing seller. In other words, it represents the fair and reasonable price that a particular asset would sell for on the open market. This valuation is crucial for accurately assessing the worth of your assets and investments, which in turn provides a clearer picture of your overall financial health. So, why is it so important? Well, for starters, it allows you to have a more accurate understanding of the value of your self directed retirement account. This knowledge is essential for making informed decisions about your investments, whether that involves adjusting your portfolio, rebalancing assets, or considering new opportunities. By having a clear and up to date understanding of the FMV of your assets, you can better evaluate their performance and determine if any adjustments need to be made. Additionally, FMVs are crucial when it comes to tax reporting. The Internal Revenue Service requires accurate reporting of the FMV of your self-directed retirement account on an annual basis. By accurately reporting the FMV, you can ensure compliance with the IRS regulations and avoid any potential penalties or audits. Not submitting your FMV by the designated timeline can have a profound consequence, some of which include fines and the potential for your account to be reclassified, resulting in unfavorable tax treatment. Furthermore, FMVs are essential for reliable estate planning. When it comes time to pass on your assets to your beneficiaries, having an accurate valuation of your asset is crucial for deciding the distribution of your estate. By having an up to date FMV, you can create and ensure that your loved ones receive their fair share and that your estate planning goals are met. Ultimately, understanding the importance of FMVs are a key to maintaining a healthy and well managed self directed retirement account. By accurately assessing the value of your assets, you can take more time to make your more informed decisions, ensure compliance with the IRS regulations, and properly plan for your future. So don't overlook this crucial step. Take the time to understand and submit your FMV by the designated deadline. Your financial health and a peace of mind may depend on it. To help you navigate this process and ensure you meet the January 31st, 2024 deadline, here are some practical tips. Start early. Don't wait until the last minute to gather the necessary information and calculate your FMV. Organize your documentation. Keep all relevant documentation in one place and make sure it's easily accessible. This may include statements from brokerage firms, real estate appraisals, or any other documents that provide an accurate assessment of the value of your assets. Consult with your professionals, and if needed, if you have unique or complex assets in your self directed retirement account, consult with professionals if needed. If you have unique or complex assets in your self directed retirement account, it may be beneficial to seek guidance from financial professionals or tax advisors who specialize in self directed retirement accounts. They can provide expert advice and ensure compliance with IRS regulations. Double check your calculations. Once you have calculated the FMV for each asset or investment in your self directed retirement account, take the time to double check your calculations. Ensure that all the figures are accurate and properly documented. Be aware of submission requirements. Familiarize yourself with the specific submission requirements outlined by the IRS. Understand what documentation needs to be included and how the FMV should be reported. Submit your FMV on time. Finally, make sure to submit your FMV by the designated deadline of January the 31st, 2024. Mark this date on your calendar and set reminders to avoid any last-minute rush. Early submission can provide you with the peace of mind and avoid any potential penalties or audits. The end of a calendar year always brings a series of deadlines and imposes timelines for the execution of tax mitigation strategies, both inside and outside of the self-directed IRAs. As we count the days left in 2023, some people might be ready to create fresh financial goals for 2024. But there are still plenty of opportunities left for the remainder of the year to enhance your investment portfolio. American IRA works exclusively with self-directed IRA community and with business owners and entrepreneurs who choose to set up self-directed company pension plans, such as self-directed solo 401ks, SEPs, and SIMPLEs as well. We're happy to work with the self-directed retirement investors and those interested in learning more about the concept from anywhere in the U.S. Again, everything that you've heard in this presentation today, highly encouraged to check in with your tax or legal professionals for any of the specific drill down questions that you might have. For those of you that have been with us over the years, and even for the folks that are brand new to our services, we're very thankful for all of you. We greatly appreciate it. And again, we wish you a Merry Christmas, Happy Holidays, and a Happy New Year. And on behalf of myself, I speak for the rest of the staff when I say we really look forward to continued success with all of you.